Welcome to the new video on the Easy Finance channel. Have you ever wondered why financial reports from different companies all seem to follow the same structure? Why do businesses record things in such a standardized way? Well, the answer lies in accounting principles, the rules that keep financial reporting consistent, reliable, and useful. In this video, I will walk you through the 7 most important accounting principles in a simple and practical way, even if you've never studied accounting before. The accounting principles are part of the system called GAAP, Generally Accepted Accounting Principles, used in countries like the US. In Europe and many other parts of the world, companies follow IFRS, which is very similar. Now, let's break down the 7 accounting principles you need to know. Accounting principles are the foundational rules and guidelines that companies follow when preparing their financial statements. These are the 7K principles we're going to discuss in this video. The entity principle, the going concern principle, the monetary unit principle, the historical cost principle, the revenue recognition principle, the matching principle, and finally, the full disclosure principle. So, the first principle we're going to discuss is the entity principle. This principle states that a business is treated as a separate legal and financial entity from its owners. That means the company's finances are not mixed with the owner's personal transactions. For example, if the owner buys a car for themselves, it doesn't show up on the company's balance sheet. The next one is the going concern principle. The principle is the assumption that a business will continue to exist in the near future, unless there's clear evidence it won't. Because of this assumption, assets and liabilities are recorded based on long-term use, not immediate sale value. If a company is expected to close soon, its financial reporting would change significantly. If your company owns a machine worth 10,000 euros, you don't record its market resale value each year. You depreciate it slowly over time, assuming you will keep using it in your business. But if your company were closing down, you would need to change how you value and report that machine. So, let's move on to the monetary unit principle. According to this principle, only transactions that can be measured in monetary terms are recorded. This means we don't include things like employee morale, brand reputation, or the value of loyal customers, even if they're important to the business. But the rule is only measurable money values count. The next principle is the historical cost principle. The historical cost principles says that assets should be recorded at their original purchase price and not at their current market value. For example, if a company bought a building 10 years ago, for example, $500,000, it stays on the books at that value, even if today it's worth $1 million. So it increased, but at the financial statements, we still record it as $500,000. This provides objectivity and avoids inflated numbers on the financial statements. The next one is one of the most important principles. It is the revenue recognition principle. It says that revenue is recorded when it's earned, not when the money is actually received. For example, let's say a company delivers a service in June but gets paid in July. According to this principle, the revenue is recorded in June, when the service was provided, and not when the money was paid. This helps match income with the right time period. Also, the next principle is quite similar. It is the matching principle. It is also really important. It is closely linked to the revenue recognition. The matching principle means that expenses must be recorded in the same period as the revenues they help to generate. For example, if you pay your employees in July for the work they did in June, that cost should be matched to June's income. This gives a more accurate picture of the profit. Last but not least, the full disclosure principle. This principle requires companies to disclose all important information that affects a reader's understanding of the financial statements. This can include footnotes about lawsuits, loan obligations, or unusual accounting methods. Transparency builds trust, and this principle makes sure companies can't hide important details. So, now we discussed all the 7 principles. Here's a short overview of all the key accounting principles. First, the entity principle. The business is separate from the owner. The next one, going concern. Assume the business will continue. The monetary unit principle, only record measurable financial info. Historical cost, record assets at purchase cost. Revenue recognition, record income when earned. Matching principle, match expenses to related income. And the last one, full disclosure, share all relevant info. These principles form the foundation of accounting, and they are used in every financial report you will ever see. If this video helped you understand accounting a little bit better, give it a thumbs up and consider subscribing to Easy Finance for more beginner-friendly finance videos. Got questions? Drop them in the comments. I answer everyone. Thanks for watching and see you in the next video. Bye bye.